Okay, good morning, everyone. I believe you can hear me. Today is the 14th day of August 2022, where we'll be discussing on other aspects of the standards, which is IFRS 3, and we'll be going back to the date of acquisition, where we'll be having extensive discussion on what is part of the requirements as at the point of acquisition. And one of the key requirements at the point of acquisition is to ensure that contingent liability that has been identified and it constitutes a present obligation, and of which we can liably measure such at acquisition date fair value, are incorporated in the identifiable net asset of the subsidiary before the acquisition method is applied. Okay, which leads us to future consolidation if it entails a parent subsidiary relationship. Okay, furthermore, we're looking at aspects of what we discussed in the contemporaneous and contemporary issues that relates to group account, where we discussed that though it is not a must that the parent and subsidiary must have the same reporting date, and not a must that they must have the same accounting policy, but IFRS 3 encourages and more or less emphasizes that upon consolidation of the parent and subsidiary, we must align all of the accounting policies of the parent and that of subsidiary to that of the group. And usually, as a practice, except in a rare situation, the entire accounting policy of the parent always represent the accounting policy of the group, subject to one or two adjustments or additions. Okay, in that light, where the accounting policy of the parent is materially different from the accounting policy of the subsidiary, therefore, what do we need to do at that point in time? And part of what we need to do at that point in time is to ensure that we more or less adjust the accounting policy of the members of the group to align together. In this case, more likely than not, we adjust the accounting policy of the subsidiary to incorporate it with that of the parent, which make up the accounting policy of the group. And this could necessitate adjustments at point of acquisition or subsequent to acquisition, as the case may be, or both. And all of these are what we'll be discussing in today's lecture. And this will launch us to our next session next week, where we'll be talking much more emphatically on group adjustment. That is, adjustment that is expected to be carried out within the group, which will entail adjustment that involve unrealized profit on either sale of goods or sale of an asset, adjustment that could be triggered by way of making adjustment to depreciation on asset transfer within the group, adjustment that can require the elimination of intercompany balances, adjustment that tends to, in the bid of eliminate intercompany balances, where so identified, goods and cash in transit are equally adjusted for prior to such elimination of intercompany balances. Adjustment of balances that relates to loan balances, one in the books of the other showing receivable loans, the other one showing payable loans. How do we eliminate? Also, with respect to dividend that is payable by the subsidiary to the parent, how do we ensure we eliminate such and also of adjustment that may come across in group account? And all of these adjustments are necessitated all to establish that at every point in time, the economic financial position of the entity and of the financial performance are what is more or less reflected in order to achieve the principle that says the group account is the account of the parent and all of the subsidiaries as if it is account of a single economic unit or a single economic entity. In that light, we'll be looking at our more or less text to look at what will launch us to our discussion. And before I venture into one or two things I'm going to discuss today, therefore, we'll need to look at our text and look at the preface and some information contained there and make 1 or 2 minutes out of it. Okay, in these slides, I want someone to more or less volunteer to take us through what is contained there in chapter 8 of our resource text. Okay, over to you. Anyone with less noise background, can you take up this discussion? Thank you very much. Mr. Dini, I believe you have no noise background. Can you take it up, sir?
Okay, sir. Other principles in business combination accounting and group accounts. This chapter will expose the readers to the understanding of the requirement of IFRS 3 and IFRS 10 on accounting for contingent liabilities at acquisition date, the requirement for uniform accounting policies and reporting dates. A practical consideration in preparing consolidated financial statements is to have information on all constituent entities current as of the partner's year end. Then, if a subsidiary has different financial year, it may be required that updated financial information is necessary as of the parent's year end in order to facilitate the preparation of the consolidated financial statements. There is a presumption, except where reputable, which is very unlikely, that all members of the group should adopt the same accounting policies and standards in accounting for similar events and transactions. In practice, this may not be, but upon consideration, it will be required to align with the accounting policies of the subsidiaries to that of the parent, which invariably may require some adjustments to be made because consolidation can be effected. Even though the requirement of IAS 37 is extremely clear that a contingent liability should not be recognized, but rather disclosed on the basis of its materiality. But with regards to business combination and group accounts, a contingent liability that satisfies the basic requirements of a liability has been probable as of the acquisition date and can be measured reliably at the acquisition date fair value may be recognized alongside the business combination accounting. Uniform reporting date and accounting policies. IFRS 10 requires a parent entity to prepare and present consolidated financial statements in any year the parent have control over another entity as at the reporting date. Since consolidated financial statements preparation is from a single economic unit or entity perspective, it is paramount and important that each member of the group adopts the same accounting policy and reporting dates. It is worthy to know that IFRS 3 allows a parent to further consolidate a subsidiary and adjust the subsidiary's account as appropriate, where the reporting dates are not the same. And that is practicable and reliable to carry out significant adjustments for transactions outside the common period. But the difference between the reporting dates should not be more than 3 months. In most cases, all group companies will prepare accounts to the same reporting date. One or more subsidiary may, however, prepare accounts to a different reporting date from the parent and the bulk of other subsidiaries in the group. In such cases, the subsidiary may prepare additional statements to the reporting dates of the rest of the group for consolidation purposes. If this is not possible, The subsidiaries account may still be used sorry, sir. I think my network dropped briefly. If this is not possible, the subsidiaries account may still be used for consolidation, provided that the gap between the reporting dates is 3 months or less, where a subsidiaries account are drawn up to a different accounting date. Adjustments should be made for the effects of significant transactions or other events that occur between that date and the parent's reporting date. Consolidated financial statements should be prepared using uniform accounting policies for like transactions and other events in similar circumstances. Adjustment must be made where members of a group use different accounting policies so that their financial statements are suitable for consolidation. Hence, consolidated financial statements should be prepared using uniform accounting policies. No alternative is allowed to the contrary. IFRS 10 states that if accounting policies differ in the individual entities, adjustments need to be made on consolidation to achieve uniformity. The following illustration will assist in establishing the principle as required by the standard as it relates to the adjustment on uniform accounting policies within the group. Illustration 1. You are given the statement of financial position of Pali and its subsidiary Suzy at December 31st, 2015. Statement of financial position as at 31 December 2015. Property, all figures are in million naira. Property, plant, and equipment. Pali 40, Suzy 35. Investment in Suzy PLC. Pali 50, Suzy not applicable. Intangible assets. Pali 10, Suzy 15. Current assets. Pali 20, Suzy 40. Total assets 120 for Pali, 90 for Suzy. Share capitals and reserves. Equity share capital at 1 naira per share, Pali 60, Suzy 50. Reserves, retained earnings for Pali 50, Suzy 20. Current liability, Pali 10, Suzy 20. Additional information. Pali acquired 40 million of 1 million shares of Suzy on 31st, 2014 for 50 million. When the reserves of the subsidiary, i.e. Suzy, showed a balance of 10 million, there has been no impairment of goodwill on consolidation since acquisition. The market price of the company's shares prior to acquisition is 1 naira 10 kobo per share. Suzy has all its accounting policies to be the same with that of Pali, except for that of intangible assets included in its books. A component of intangible assets of Suzy is a type whose recognition will not be permitted under IAS 38, intangible assets. IAS 38 is to be allowed in preparing the consolidated financial statements. When Pali made its investment in Suzy on 1st January 2014, the intangible assets of Suzy included 8 million that will not qualify for recognition under IAS 38. The intangible assets of Suzy are of indefinite life. We are to assume that Susie operates under different accounting standards, which are similar in all respect to IFRS, except for some aspects relating to recognition of intangible assets.
Thank you very much. Therefore, what are we trying to buttress? With respect to uniform accounting dates, we've discussed it in the session where we discussed extensively on contemporaneous contemporary issues in group account and business combination. Now, in that situation, we discussed that though it is encouraged that the reporting date of the parent and that of the subsidiary should be the same, but in practical sense, they may not be the same. And where they are not the same, consolidation can still be done directly, provided one, that the reporting dates are not far apart. And the threshold adopted by the standard is 3 months, which means if the reporting dates differ by 1 month, 2 or 3 months, consolidation can still continue to be done as if they are of the same date, subject to adjustments for material transactions, which means if there are material transactions that does occur during the period, you must adjust for that. And we also extend our discussion to the fact that what if practically the reporting date differ for more than 3 months? Okay, what would that necessitate is that there may be need to reconstruct, which we demonstrated with some illustration and practical graphing or pictorial representation then, which you can go back to the video on that. Now, we discussed that we need to reconstruct the financial statement of the subsidiary to align with the reporting date of the group, which is that of the parent, so that in that situation, consolidation can then proceed. Okay, but we won't be able to demonstrate that competence or capacity in this section, or because we don't have different financial statement of 2 different dates, and the process of now reconstructing is something that takes a long time. Like we are preparing, we are more or less preparing financial statement from the beginning by joining part of certain prior period with part of current period in order to produce that stretch. But the one that can easily be demonstrated in our session is that relating to uniform accounting policy. Also, similar to accounting dates, it is expected that the accounting policy of the parent and the subsidiary should be the same. But where they are not the same, due to various factors such as industry practices, and they belong to different industry, some such as regulatory guidance or carve-out, where regulator has specified that for this industry, this is a policy that must be generally adopted, okay, and for some other factors. Therefore, where such accounting policies are not in tandem with that of the group or the parent, it then means that before you consolidate this subsidiary's account, you adjust that account in such a way that it reflects the accounting policy of the group. And we are going to be able to use this illustration, which was read by Mr. Adeni, to more or less demonstrate our little understanding. And from the question he read, what is our understanding can be found here, which speaks to the fact that the subsidiary has an accounting policy, or because it prepares his account in different GAAP. GAAP means generally accepted accounting principle. What that simply means is that in this situation, probably the subsidiary is using US GAAP, and from all the transactions that has entailed, the only aspect that differ primarily may be attributed to intangible assets, where the intangible asset that was recognized by subsidiary, if you are to go by the way of IFRS under IAS 38, may not have qualified, which is what has been presented to us. Which then means that in such a case, IAS 38 may have said such an item that constitutes what you consider as intangible asset should have been expensed, whereas you have capitalized it as an intangible asset, and therefore in that situation, what then do we do? We need to go by IFRS, which is that of the parent. Okay, and that's what we wanted to do. And to simplify this question without having subsequent effect is that we have more or less been told that the intangible asset is of a nature that the useful life is indefinite, or probably we'll call it indeterminable, which means such intangible asset was not subjected to depreciation. And I'm going to tell you, if immediately we finish solving this problem, I'll also try to more or less put your attention to the fact that what if the intangible asset are subjected to depreciation? What further adjustments will be required in order to eliminate any form of depreciation impact in the subsidiary's profit or loss in relation with such an intangible asset? Now, to do this, we will switch back to our Excel model where we'll use it to solve our problems. Okay. Now we are back at our Excel model, and on that premise, we should be able to more or less provide solution. The same question is what is before us as question 13 in our Excel model. And we'll try to solve the problem as it is. But before then, I believe Madam Shade can hear me now, because she says I can't see anything on the screen.
Yes, sure? I can see now. I can see the screen now.
Okay, thank you very much. And two, there's a question from Esther who says, can you give me a guide when subsidiaries company reporting they differ with more than 3 months? And I think I've explained again. And if you go back to the initial video where we discussed on contemporary issues in group accounts, we said, for example, if you are a foreign company, for example, even if you're a local company, and your reporting date is every 31st of May, due to your industry, for example, your competitors, all of them have May. And in order to more or less have your results comparable with that of your competitors, you are also choosing May, and you are the parent entity. Whereas your subsidiary is a bank in Nigeria. A bank in Nigeria, as financial institution, or what they call them as deposit money bank, compulsorily must prepare accounts from January to December, which means December is compulsory year end for every bank. And in that situation, the bank will have its year end as December, whereas the parent has a year end as May. And when you look at it, when the parent is to consolidate the account in May, is consolidating 5 months after the reporting date of the subsidiary, which then requires that we can't be able to consolidate the way we are required under IFRS 3, under IFRS 10. But what then do we do is for us to more or less reconstruct the account of the subsidiary in such that we are able to capture 7 months from the last year and 5 months from the current period to produce that 12-month result that will span between 1st of January to 31st of December. And that's what we're trying to explain. Okay, now let's look at this question. Again, in this question, as opposed to the other question we are used to, you'll find out that what is given here is that we are not given our percentages. Okay, now, even though we have a template showing this, we'll more or less change it. Now, in this case, we are told that Pali acquired 40 million of the 1 Naira shares of Suzy on 1st of January 2014 for 50 million Naira. Which means that there's an additional step we need to take is to determine the percentage, the parent stake in the ordinary share capital of the subsidiary. Which means in this case, we need to determine the percentage. Now to determine that, what is my cost, my percentage holdings? Okay, and this is measured by saying, we compare number of shares, subsidiary shares, acquired by the parent. Okay, and we are going to do that as a ratio of the total number of shares of the subsidiary in issue. That is the number of shares it has issued. Okay. Now, whatever we get here will give us what's supposed to be. Now, what is it? Number of shares acquired in the subsidiary, according to this information, is 40 million. And how many shares are existing in subsidiary? Remember, we have 50 million share capital and the nominal price is 50 naira, which means the number of shares there is 50 million divided by 1 naira, which is 50. Therefore, in that case, whatever we have here is in millions of shares. And what is that? It's simply ratio 40 to 50 will give me 80%. And that's how we got the 80%. Now this 80%, let me highlight it in yellow, is what I will link here so that I can get my non-controlling interest. Now, peradventure, the examiner has said it's 35 million we acquire. So 35 million. Therefore, we'll have gotten 70%. Let's say we acquire 28 million shares, we'll have gotten 56. And this is the benefit of model. Everything continues to change. Well, let's go back to what it is, which is this. Which means that's an additional step we are taking. Okay, now let me switch back to my my notebook, so that I can draw the group charts. What is our group stuff again? My group structure is such that Pali acquired Susie 80%, NCI 20%, date of acquisition on the question was 1st of January 2014, and we are reporting, which is date of consolidation, that's 1st of December 2015. I guess, yeah. If you check it well, this is 2-year gap, 2 years. Okay. Now, in that case, I can copy this and take it to my worksheet. Now I'm at my worksheet. I can paste it somewhere here. Okay. Now, what is investment in Susie? As at acquisition, investment in Susie was said to be 50 million. Therefore, ordinary share capital in Susie is said to be 50 million again, just a mere coincidence. And the pre-acquisition reserve, we're told that as at acquisition, the reserve of Susie stood at a balance of 10 million. Okay? It's not negative, otherwise it should have been clearly stated. Therefore, I can come here and say my pre-acquisition reserve is 10 million. Now, what is the reserve as at the reporting date? Is 20 million. Therefore, I'll put that there. Automatically, I've been able to derive my post-acquisition profit. Okay, now, what is germane here is that as at the point of acquisition, part of the steps and processes we've more or less discussed earlier in previous session was that IFRS 3 requires that at the point of acquisition, the parent, in this case, which is the acquirer, should first identify and recognize all assets and liabilities at their fair value. Now, if you check this, there is an intangible asset in the books of the subsidiary to the tune of 8 million naira that was part of the subsidiary's asset, which does not qualify as an asset, as the case may be under IAS 38. And therefore, such will have been expense, and the implication is that the asset will have been a reduced amount. Likewise, the reserve at acquisition will have been a reduced amount, thereby necessitating a reduced amount of net assets. And in that case, what then do we do is that part of the adjustments required at the point of acquisition is that the fair value of the intangible assets is slightly different. Now, we are told that the intangible asset has remained the same. Nothing has changed. There has not been acquisition or disposal, and it has not been impaired, and neither has it been amortized, all because we are told that it's of indefinite life. Therefore, what we have in the balance sheet is 15 million. Of this 15 million, 8 million of it is not to be recognized, which means invariably the fair value recognized at acquisition was the difference between the 15 million and the 8 million. And in this case, the difference gives rise to 7 million. And 7 million will represent our fair value in that case. Now, when you consider the fair value of 7 million as opposed to our kind amount, which is 15 million. I remember I've explained, though this is 15 million in 2015, but because of these assumptions that we have here, and even some information here, it's so clear that this 15 million has not changed since acquisition in the last 2 years. Therefore, that 15 million is what we also have here. At the end of the day, there's like a fair value loss. Again, the fair value loss here, I can attribute it to the intangible assets. And in this case, it can be seen to be an adjustment to reflect accounting policy of the group. Okay, to reflect accounting policy of the group. Therefore, in this case, what will I do? Okay, that is this case, okay? Okay, now that is that. Okay, therefore, this adjustment, how do I pass the entry? Okay, treatment of the fair value loss or differences in accounting policy. Therefore, I'm going to, in this case, debit, because it's a loss, and debit the pre-acquisition reserve, because this occurred at acquisition. And if it's at post-acquisition, it will be the retained earnings post-acquisition, and credit the intangible asset, or because you have to reduce. Okay. Therefore, in this case, then what happens? That is the sum of 8 million. Okay. Now, what then do? We go back to our books. Under first principle, what is the purchase consideration? Okay, it's 50. We have it here. Now we'll come back to NCI, but the share capital of Susie is another 50. We have it here. And pre-acquisition reserve, we've done it here. It is 10. And that's 60. Now we have this adjustment. Okay. And this adjustment flows from here, which means it's a reduction. Okay, we said we should reduce our intangible assets in the group. And that's a loss, which means automatically our fair value now is lower than the current amount, which is now 52. Okay, therefore, this provides us with a negative goodwill, but I won't say it's right because we've yet to account for NCI. And accounting for NCI means proportionate share, which is 20% in this case. And what is our net asset? Our net asset is 52, all things being equal, if I'm right. %20 of 52. That should be 20% of 52. That should be in decimal. What is it? 10.4. Therefore, we can come here and say this is 10.4. Okay, let's put everything here to one decimal place. Okay. Okay, now that is that, which means we have a goodwill of 8.4. Now, here we have NCI to be 10.4. What then do we consider? The considered share of profits, which is 20%. 20% of post-acquisition, which is 10. And we can do that, 20% of 10 is 2. Okay, therefore, . And that gives us 12.4. Palace reserve. Palace reserve is 50. And it's still going to take share of 20% of that 10. And 20% of 10 is 20%. Side. Okay. It's not allowing me to click. Why? %20 of 10. That is 2. Not 20. Sorry, the parent is 80%. Sorry. 80% of 10. 80%, that's 8. Okay. That's 58. Now, at the end of the day, we can come back here and try and prepare our consolidated accounts. Now, PPE is 40 and 35. So 40 and 35 here. $40, 35, that's 75. Goodwill is 8.4. But we still have other intangible assets already, 10 and 15. I'll come here, others. We have 10 and 15. But remember, in the intangible asset, we said we should pass an adjustment to reduce it by 8 million. Being this 8 million arising from the fair value adjustments. And therefore, I'll say minus what? 8. I remember I can put this 8 with asterisk and in red, if likely, for us to understand there is an adjustment that flows from somewhere. And in that case, we'll come here and say 10 plus 15 minus this 8. Okay, and that's how we arrive at 17. Okay. Now, what's our current assets? 20 and 40. And that should give us 60. Share capital is 60. Consolidated retained earnings is 58. NCI is 12.4. And current liabilities is 10 and 20. Okay, that is that. Now we are able to do that on the premise that we measure NCI at proportionate share. Now, if we come back here to repeat the same process, but measure NCI at fair value, that means that we need to determine what is the share capital of Susie. From the question, the share capital of Susie is 50 million, which is here. Therefore, we say 50 million divided by 1 naira as the nominal price. And what does that give us? 50 million divided by 1 naira give us 50 million shares. Okay, the 1 naira is given to us here. Now, number of ordinary shares for the entire company has been derived. Now, number of shares held by NCI in Susie then will be 20%, which you have here, of the 50 million shares, which came from here. Okay, and therefore, we are able to have 20% of the 50 million shares. And that gives us 10 million shares. And that 10 million shares is what we are told the market value is 1 naira 10 kobo. Come here, market value of 1 naira 10 kobo. What does that give us? 1 naira 10 kobo multiplied by 10 million shares will give us 11 million naira, which comes here. I remember we already know our investment by the parent was 50 million. Now we know the share capital of the subsidiary was incidentally 50 million. And we know our pre-acquisition reserve was 10 million. And we are also aware of this new adjustment coming in now. And the adjustment is linked to what we have here. Therefore, it's still 52, it doesn't change. Now, our goodwill here, if you have to go by the same methodology to wrap it up to 1 decimal place, let me format it. Will be 9 million as opposed to 8.4 million. And in that case, we come here, this is 9. This has not changed. This has not changed. It's just for me to link appropriately to this. And this has not changed. Share capital has not changed. But let us complete our process. Now, our share of profits was 20% of the post-acquisition. And that gives us 13, which means I can come here and say NCI is 13. The parent has profit or retained earnings of 50, and it's also to share in similar vein here, 80% of 10 million, which is 80% is here. of the 10 million. And that gives us 58. We also come here and take this as 58. And thereafter, this has not changed. And this is how we produce our results, which means the only principle that is new to us is issue of realigning accounting policy. And also, as I said earlier, what if this intangible asset has been depreciated before? What then you do is that you will identify how much of depreciation has been charged in the last 2 years. And this will have reduced the profit of the subsidiary. And therefore, what do? You restate back the profit of subsidiary by more or less increasing subsidiary's profit and reducing that charge on the intangible assets. Similar to what we've done with respect to fair value on assets that is depreciated and also of change. Okay, and that's that. But in this question, it is so simplified that we have no impact of depreciation because the asset was not depreciated on the premise that it is of indefinite life or of an indeterminable useful life. Any question on this? Any question on this? Any question on this? Everyone is silent? Does it mean all is well? And if all is well, can you make 1 or 2 remarks, if any, before we venture into the aspect of adjusting or recognizing contingent liability?
Yes, sir. I'm okay.
Okay. Who else?
I said I'm okay. I'm okay with your explanation, sir.
No problem. Who else? Who else again is okay or not okay?
I'm okay, sir. No question for me.
Mr. Dini, are you okay? Madam Janet, are you okay?
I'm okay, sir. Thank you, sir.
Madam Shadi, are you okay? Okay, now let's continue. Let's now venture into another aspect where we'll deal with the contingent liability. Okay, Mr. Dini, can you assist us to do this? And from there, I will explain and try to use illustration to demonstrate our understanding once again. Thank you.
Contingent liabilities. Contingent liabilities usually give rise to material loss upon crystallization, which is expected to be incorporated in the financial statement of companies. Contingent liability of the acquiree for consolidation purpose are recognized in their face value and can be measured reliably. A contingent liability in this instance must be recognized even if the outflow of future economic benefits is not probable, provided there is a present obligation. This is as opposed to the criteria of IAS 37, provision contingent liabilities and contingent assets. Contingent liabilities are not normally recognized, but only disclosed. After their initial recognition, the acquirer should measure contingent liabilities that are recognized separately at the higher of A, the amount that will be recognized in accordance with IAS 37, and B, the amount initially recognized. Invariably, it means that the recognition of contingent liabilities upon acquisition will reduce pre-acquisition reserves of the acquiree, i.e. the subsidiary. Recognition of contingent liabilities on acquisition debit reserves, that is the retained earnings of subsidiary, credit contingent liabilities, i.e. the account payables, with the contingent liabilities measured reliably. There exist instances where the subsidiary has adjustments to the subsidiary's contingent liabilities subsequent to acquisition. The recognition of such will only affect the post-acquisition reserves in the subsidiary upon consolidation. Excerpt from IFRS 3 as revised on contingent liabilities. Contingent liabilities, IAS 37 provisions contingent liabilities and contingent assets. Defines a contingent liability as A possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more certain future events, not wholly within the control of the entity, or a present obligation that arises from past events but is not recognized because either it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. The requirements in IAS 37 do not apply in determining which contingent liabilities to recognize as of the acquisition date. Instead, the acquirer shall recognize as of the acquisition date a contingent liability assumed in a business combination if it is a present obligation that arises from past events and its fair value can be measured reliably. Therefore, contrary to IAS 37, the acquirer recognizes a contingent liability assumed in a business combination at the acquisition date, even if it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation. Shall I continue, sir?
Yes, sir.
The following illustration will assist in establishing the principle as required by the standard as it relates to the recognition of contingent liabilities on the acquisition. Illustration 2. Given the statement of financial position of Pali and its subsidiary Suzy at 31 December 2015 are as follows. Statement of financial position as at 31st December 2015, Pali and Suzy, all figures in million naira. Property, plant and equipment, 40 for Pali, 50 for Suzy. Investment in Suzy PLC, 60 for Pali, non-applicable for Suzy. Current assets, 120 for Pali, 90 for Suzy. Total asset 120 for Pali, 90 for Suzy. Financed by share capital and reserves. Equity share capital at 1 naira each. 60 for Pali, 50 for Susie. Reserves, i.e. retained earnings, 50 for Pali, 20 for Susie. Current liabilities, 10 for Pali, 20 for Susie. Additional information. Pali acquired 40 million equity shares of Susie on December 31, 2015. The market price of the company's shares prior to acquisition is ₦1.50 per share. There was a liability that is contingent upon unfavorable legal disputes to the right to intellectual property, which is estimated reliably to cause the subsidiary award of damages of 5 million. The suggested solution to the above illustration can be carried out based on the underlying steps earlier. Next step, sir.
Now we'll stop there. We'll stop there. We'll look at this. We want to solve this problem. Now let's look at our own steps. Let's try and take our steps and try to understand. But before then, let's go back to this. As I said earlier, naturally contingent liability are not liabilities. Okay, and that's why we call them contingent liabilities, but rather we disclose them rather than accounting for them. And this is solely within the requirement of IAS 37. But as we move on, we'll discover that there's an exception to that rule, and that exception only comes to play in the process of business combination. And in line with IFRS 3, IFRS 3 mandates us that provided certain conditions are fulfilled, the contingent liability of an acquired business may be recognized in the course of acquisition. And the conditions include one, that there's a present obligation and not necessarily a possible obligation. And that's why we went back to IAS 37 to understand the distinguishing factor between a possible obligation that is contingent and a present obligation that is contingent. Upon doing so, we also tend to understand that if we then can measure with degree of reliability the acquisition, the fair value of such a contingent liability, such should be brought into books. And also, the reason being that most times those contingent liability may have a clause attached to them in the closeout document of the acquisition that speaks to indemnification assets. I remember our discussion with respect to contemporary issues in group account, we dealt with indemnification assets. And because we are likely to recognize indemnification asset, and that's why we are more or less likely to recognize contingent liability in order to match it appropriately. Now, in that situation, therefore, what happens is that we compulsorily must recognize contingent liability once those conditions have been fulfilled. And we need to recognize it only at acquisition date and measure them at acquisition date fair value. And how do we do that is what we are considering. Now, subsequently, you can now recognize them at the more or less higher of what you'll have recognized it in terms of IAS 37, or what you'll have recognized based on what it is after making some relevant adjustments. And I think if you go back to, I think it was in chapter 2 or 3, we spoke on basic principles, which are contemporaneous issues, okay? Now I can take you back to it here, where we speak on it, contingent liability. Okay, as you all see here, that after initial recognition in line with IFRS 3, you are compulsorily required to measure it at the higher of what you have recognized under IAS 7, okay, or what you initially recognized it in under IFRS 3 or IFRS 15 with respect to revenue, if appropriate, less any cumulated amortization that has been carried out. But in this case, now we'll go back to our question and try to have a better appreciation of what we are talking about. Now, in our question, which are put on our spreadsheets. Therefore, what do? Is that let us see the effect of the requirements upon acquisition with respect to contingent consideration. I'm sorry, contingent liability. Now, this is a question once again. Okay, now we'll go back again. We also told that Pali acquired 40 million ordinary shares. Okay, and I think the information is similar to what we have before. Therefore, instead of wasting our time, what I'll simply do at this point is to come here and more or less copy this information. Okay, so that I don't duplicate efforts. Okay, since acquisition took effect, when was the acquisition? Okay, the acquisition was, okay, we are still at the date of acquisition. Therefore, this chart will not be relevant. Therefore, I can go back to the chart to reflect what is supposed to be. Okay, what will be the chart in this case? The group structure. Is Pali acquires Suzy, and we have NCI. Now, this is already determined at 80%, and this is determined at 20%. Date of acquisition is that 1st December 2015, which coincides with the same date of consolidation. Therefore, I can copy this placement for what was there before. Okay. Now, in this slide, what can I do is to bring it down here. Okay. Therefore, the reserve at acquisition and reporting are the same. Therefore, I can come here. The investment was 60 million. The ordinary share capital of subsidiary is 50, and the pre-acquisition reserve is 20, since the reserve are the same. Okay, 20 is obtained from here. Now, what is our pre-acquisition? Is this 20? And our balance sheet is also still showing 20, all because it's the same day, which means there's no post-acquisition reserve. I think it's simple for us to know that. Now, what is the purchase consideration? It's 60 million, as we have earlier. We'll come back to NCI, but the share capital of Suzy is 50. The pre-acquisition reserve is 20. But this carrying amount did not reflect all of the identifiable net assets. Therefore, upon acquisition, we are able to establish here that there was a liability contingent upon unfavorable legal dispute to the right to intellectual property, which is estimated reliably to cost the subsidiary the award of damages of 5 million naira, which means they have been able to reliably estimate the value, which means initially the carrying amount of the liability was 0. Remember, in this case, it's not an asset, but rather a liability, contingent liability. Now, the carrying amount was 0 because there was nothing recognized for, but now the fair value, according to this information, is 5 million, which means in this case, the fair value of the contingent liability is higher than the carrying amount of that contingent liability. Is it a gain or a loss? Who can answer that? Is it a gain or a loss?
Yes.
It's a loss. Take note of it because we are looking at liability. And I think I can take you back to our material, our notebook, where we discuss this extensively. Let me move it upward. If you remember, we did this analysis that day. Now, this is a liability, okay? Where in this case, the fair value is higher than the current amount and it creates an expense. Remember, a loss is an expense from the conceptual framework. And that brought us to doing what we are to do now, which means we reduce our reserve at acquisition by that amount and increase our liability, which means that is what we are going to do in this case. Okay. Now let's go back to our spreadsheet. Therefore, in this case, what will I do is for me to do the needful. And the needful is recognize this accounting entry. And come here to recognize contingent liability. And this one is arising from acquisition. We need to be very careful. Acquisition or a business combination. And therefore, that's 5 million. Okay. Now we'll come back here to recognize that fair value. Okay, I'll come here and say fair value adjustments. With respect to contingent liability. Okay. No, sorry. Where's I went to? Sorry. It's not, see where I did. No, this way I'm supposed to take it to. Okay, how much is it? Because we are told to reduce our reserve, it is negative. Okay. Now, this gives us 65 as our net assets. Therefore, we have to measure that. What percentage? I think it's 20%. 20% of 65. And 20% of 65 will give us 13 million, which is there. Okay, NCI is 13. Now, upon consolidation, we have no post-acquisition reserve, which is 0, which means it's just mere 20% of 0. If I come here, 0. Okay, the parent has reserve of 50. If I come here, I say 50. And this also is 0. Okay, 80% of is 0. Okay, and that is also 0. Okay, therefore, we can come here and consolidate. PPE, 40/50. 40 for the subsidiary, 50 for the 40 for the parent, 50 for the subsidiary. Goodwill, if any. In this case, we have negative goodwill. Therefore, goodwill here is 0, which means in this case, I just have to strike it out. Okay, let me strike it out in red. Which means I have no amount of goodwill. Rather, it is negative in nature. Therefore, in this case, this calculation produces negative goodwill. In that case, I think I have the description somewhere here. I can copy and paste. Okay, I have it here as bargain purchase. Let me just copy and paste it there instead of wasting time. Yeah. In that case, what I have here is gain on bargain purchase or negative goodwill, as the case may be, which means I can emphasize here that the calculation produces negative goodwill. Okay, in that case, I have to come here and introduce that in the period, gain or bargain purchase. As I said earlier, in other sessions that we've done, we said the gain on bargain purchase is attributed to the parent only, which means this sum is a gain to the parent, which gives us what it is in that case. Now, in that case, we come here, parent equity 60, consolidated retained earnings incorporating gain and bargain purchase 55, even though we've not shared any post-acquisition profit. NCI, the team as of acquisition. Acquired liabilities 10 and 20. $10 and 20. Okay, we come here, current assets, 20 and 40. $20 and 40. Now, what do we have here? We've not recognized contingent liability, yes. Let me add it here. Plus, what's our contingent liability? 5. Remember, we have 5 contingent liability here, which we have said we should credit. Okay, I'll come here, plus 5. I will take it and put it in red. Which means I have to add a 5 to it. And that gives me 163. Okay. Now, again, I need to be very careful. Are you sure we have a gain? NCA has not been accounted for here, which means that might be what erroneously makes us consider it as a gain. Now, what's our NCA? It's a T. We didn't link it here. We're sorry for that. And nobody has come our attention, which means there's no gain. It was erroneous gain. And that is why, and I think it's also fortunate that this happened. That is why, if you remember, under IFRS 3, it says, whenever you have a negative goodwill, please carry out a reassessment. And the assessment is to check whether you have appropriately measured all identifiable assets and liabilities, including consideration and acquisition date fair value. And 2, identify whether there's no error made. Now, if I've not cross-checked this, we'll have more or less considered an error to force us to recognize a gain from bargain purchase when there's none. In this case, let me quickly take us back to our material that speaks to recognition of gain on bargain purchase. And I believe that is page, that's chapter 5. Okay. Chapter 5, okay, yeah. Now let's look at the relevant aspect that speaks to gain on bargain purchase. Okay. Now, can somebody read this again? Mr. Adeni, can you assist us here?
Yes, sir. In some business combination, but usually in an extreme case, the consideration transferred and transferable may be less than the fair value of the net assets acquired. This situation results in negative goodwill, which is often identified and recognized as a gain from a bargain purchase transaction. IFRS 3, as revised, suggests that since arm's length business acquisition transactions will usually favor neither party, the likelihood of the acquirer obtaining a bargain is considered remote. The standard IFRS 3 revised apparent instances of bargain purchase transactions giving rise to a gain from bargain purchase are more often the result of measurement error or errors, which include the measurement of the fair value of the consideration transfer and those transferable, and the fair value of the identifiable assets and liabilities of the subsidiary upon acquisition. Furthermore, gain from a bargain purchase can also be derived from the risk of future losses recognized by both parties and incorporated into the transaction price. IFRS 3 as revised requires that the fair value of the consideration and the fair value of net assets acquired are reviewed, including contingent liabilities that are probable at acquisition and of which the fair value can reliably be ascertained as of acquisition date, and checked carefully to ensure that errors have not been made. After the review or assessment is completed, and indeed the fair value of the identifiable assets acquired, net of all liability assumed, exceeds the fair value of the total consideration transferred, then a gain from a bargain purchase will be acknowledged and immediately taken into profit, i.e. recognized directly into income statement of the group. We can explore.
Thank you very much, sir. Yeah. Now, which means the error we made has not been identified. And therefore, we'll go back and make correction for the error because there was no gain, which means we can go back and recognize what's supposed to be our goodwill. Therefore, in this case, we'll go back and see that there was no gain. Is this our 8 we have at the end of the day? Okay, therefore, which means all efforts I've done here, I have to reverse it. No gain. Just take note of that. Okay, we are back at 50. Therefore, we'll come back here to recognize that we have goodwill. Okay. Okay. Therefore, I go back and link it up. This is goodwill. Now we are home and dry. We are back on our normal spots. And that is the beauty of it, that there's nothing like negative goodwill. Rather, we were deceived by not recognizing the amount of NCI before reaching that conclusion. And that's the beauty in this case, that we have been able to practically demonstrate how erroneously we will have gone ahead to recognize gain on bargain purchase when actually there's none. Okay, now that is that. Now for this other one, we'll look at it again, and I think our market price is 150 kobo. Okay, the other one we solved then was 1 naira 10 kobo. Therefore, we can come back here and pick it one by one. Our share capital is 50 million. Okay. Nominal price is 1 naira. And by so doing, we are dividing 50 naira divided by 1 naira. And that should give us what? 50 million naira, which we have here, divided by 1 naira, will give us 50 million shares. Okay, thereafter, these 50 million shares, NCI has 20% stake in it out of the 50 million. And therefore, how many shares does that amount to? 20% of 50 million shares. 20% of 50 million shares was 10 million shares. And this 10 million shares is valued at 1 naira 50 kobo and not 2 naira. At the end of the day, 1 naira 50 kobo times 10 million shares will give us what? $150 kobo times 10 million shares. Give us 15 million. Okay, we can bring our NC at 15 million, given that our purchase consideration from the perspective of parents remain the same as 60, share capital of subsidiary remains the same as 50, and pre-acquisition remain the same at 20. Okay, now we have the fair value, which we'll bring in for the contingent liabilities. And as we are advised to reduce our pre-acquisition reserve by that amount, we are doing the same. Okay. And that's give us back our 65, the same way we have it here, the same way we have it here. Now, in this case, what do we have? We have 10 as our goodwill as opposed to 8, which means I can come here and say my goodwill is 10 as opposed to 8. 90 remain 90. 60, current assets remain 60. 60 share capital remains 60. Now my consolidated, I have to bring in my Palace reserve, which will have to be 50 plus the share, which I can pick from here. It is 0. Okay, and that shows me 50. And likewise, SCI also, I pick what is here, which is also 0. And that shows me 15. NCI is 15. Okay, and this remains 35, the way it is. Okay, remember this 5 is coming from where? This 5 is coming from here, which I can equally do here, so that I can trace the adjustment where is it coming from. And that is that. And that is a position, which means this is how we proceed upon acquisition to incorporate the fair value of the contingent liability where necessary and required using acquisition day accounting. Any question on this? Any question on this? Any question on this?
No question, sir.
Not for me, sir.
Okay, if there's no question, the session in which we'll be wrapping it up will be strictly on looking at our chapter 3, where we'll be looking at chapter 3. There we'll be looking at how do we account for investments of the parents in the subsidiary in its own separate financial statements, which will be in tandem with the requirements of IAS 27. And that's what we'll be looking at in the next section, or in the next discussion we are having today. Okay, we are going to look at the aspect of the standard that speaks to how to account for investments that the parent has in a subsidiary in its own financial statements. And we'll start from the perspective of what is a separate financial statement. Now, I'll give you a clue to it, and we'll later delve into it more extensively. Now, when we talk about separate financial statements, the word separate is a qualification of that financial statement. Okay, what it simply means is that the financial statement of a parent entity separate from that of the group is what we call separate financial statement, which means we can only make use of the word separate financial statement in the context of a parent entity only, which means we don't use it in the context of any other entity, which means it's only if you are a parent and you prepare group account that we can characterize your own financial statement as separate financial statements. And what does that infer? Because there's a provision of IAS 27, which provides some level of definition and exception with respect to certain requirement of other relevant standards with respect to recognition and measurement of investment in other entities. And it's from that perspective that we are going to answer this question. A separate financial statement is the financial statement of an entity separate from the group account, which then means that it's only restricted to the fact that, first, the entity in concern is a parent entity, and that is a parent entity that prepares group accounts, and in that case, its own financial statement will be termed and deemed separate financial statements. Whereas its own financial statement combined with that of the subsidiary are what are termed as group or consolidated financial statements. Now let's look at the perspective of IAS 30, that's IAS 27. And in that light, I'm going to more or less share something with you. Okay. I'll look at this position from the summary of IAS 27 by IAS Plus. Okay, let me share the screen. I believe you can see the screen. Now let's look at the definition first. Here, when we say consolidated financial statement, is the financial statement of a group in which the asset, liabilities, equity, income, expenses, and capital of the parent and the subsidiaries are presented as those of a single economic entity. But this is where we are concerned about. Separate financial statement is a financial statement presented by a parent, that is an investor with control of a subsidiary, and investor with joint control or with significant influence over an investee in which the investments are accounted for at cost or in accordance with IFRS 9, and that is at fair value. Okay, now let's look at what we are looking at here. Can somebody read this for us before I come back to make some revelations? Okay, who will read?
Preparation of separate financial statement. Requirements for separate financial statement. IS 27. Can we hear me?
Yes, I can hear you.
IS 27 does not mandate which entities produce separate financial statements available for public use. It applies when an entity prepares separate financial statements that comply with the National Financial Reporting Standard IFRS 27, 2007, subsection 3. Financial statements in which the entity method is applied.
Requirement for separate financial statement.
I'm already reading. Financial statement in which the equity method is applied are not separate financial statements. Similarly, the financial statement of an entity that does not have a subsidiary, associate, or joint venture interest in a joint or joint venture interest in a joint venture are not separate financial statement. An investment entity that is required throughout the current period and all comparative period presented to apply the exception to consolidation for all of its subsidiaries in accordance with IFRS 10. Consolidated financial statement presents separate financial statements as its only financial statement. The investment entity consolidation exemption was introduced into IFRS 10 by investment entity issued on 31st October 2012 and effective for annual period begin on or after 1st January 2014. Choice of accounting method. When an entity prepares separate financial statements, investment in subsidiaries, associate and jointly controlled entities are accounted for either IS 27, 2011, maybe paragraph 10, at cost or in accordance with IFRS 9 financial instrument, IFRS 39 financial instrument recognition and measurement for entities that have not yet adopted IFRS 9 or using the equity method as described in IAS 23. 28. Investment in associate and joint venture. See the amendment information below. The entities apply the same accounting for each category for investment. Investments that are accounted for at cost and classified as held for sale in accordance with IFRS 5, non-account current asset held for sale and discontinued operation are accounted for in accordance with IFRS. Without IFRS, investment carried at cost should be measured at lower of their carrying value and fair value less cost of sale. The measurement of investment accounted for in accordance to IFRS 9 is not changed in such circumstance. If an entity elects in accordance with IAS 28 as amended in 2011 to measure its investments in associate or joint venture at fair value through profit or loss in accordance with IFRS 9, it shall also account for those investments the same way in a separate financial statement. IAS 27, 2011, paragraph 11. Investment entities. Note, investment entity consolidation exemption was introduced into IFRS 10 by investment entities issued on 31st October 2010 and effective for annual period beginning on the 1st January 2014. If a parent investment entity is required in accordance with IFRS 10 to measure its investment in a subsidiary at fair value through profit or loss in accordance with IFRS 9 or IAS 99, it is required to also account for its investment in subsidiary in same way in separate financial statement. IAS 27, 2011, paragraph 11a. When a parent ceases to be an investment entity The entity can account for investments in subsidiary at cost based on fair value at the date of change or status or in accordance with IFRS 9. When an entity becomes an investment entity, it accounts for an investment in subsidiary at fair value through profit or loss in accordance with IFRS 9. IAS 27, 2002, paragraph 11b.
Here is some information for IFRS 9.
Recognition of dividend. An entity recognizes a dividend from a subsidiary. Joint venture associate in profit or loss is separate financial statement when its rights to receive the dividends is established. Accounting for dividends where the equity method is applied to investments in joint venture and associates is specified in IAS 28, investments in associates and joint venture. Group reorganization. Specified accounting apply in separate financial statement when a parent reorganizes the structure of its group by establishing a new entity as its parent in a manner satisfying the following criteria. IAS 27, 2011, paragraph 13. The new parent obtained control of the original parent by issuing equity instruments in exchange for existing equity instrument of the original parent. The assets and liability of the new group and the original group are the same immediately before and after the reorganization. And the owner of the original parent before the reorganization have the same absolute and relative interest in net asset as original group, and the new group immediately before and after the reorganization. Where these criteria are met, the new parent accounts for its investment in its original parent or cost. The new parent measures the carrying amount of its shares of the equity item shown in separate financial statement of the original parent at the date of reorganization. IAS 27, 2011, paragraph 13. The above requirements apply to the establishment of an intermediate parent with a group, as well as establishment of a new ultimate parent of a group. IAS 27, 2007, BC 24. Apply to an entity that is not a parent entity and establish a parent in a manner that satisfies the above criteria. IAS 27, 2011, paragraph 40. Apply only where the criteria above are specified and do not apply to other types of reorganization or for common control transaction more broadly. IAS 27, 2011, BC 27. Disclosure. When a parent in accordance with paragraph 4, section A of IFRS 10 elect not to prepare consolidated financial statement and instead prepare financial statement, it shall disclose in those separate rates financial statement IAS 27, 2011, paragraph 16. The fact that the financial statement are separate financial statement, that the exemption from consolidation has been used, the name and principal place of business, country of incorporation, if different, of the entities whose consolidated financial statement that comply with IFRS has been produced for public use, and the address where those consolidated financial statements are obtained. A list of significant investments in subsidiary, jointly controlled entities and associates, including the name, principal place of business, and country of incorporation, if different, proportion of ownership interest, and if different, proportion of voting rights, and a description of the method used to account for the foregoing investment. When an investment entity that is a parent prepares separate financial statement as its only financial statement, it shall disclose that fact. The investment entity shall also present the disclosure relating to the investment entity required by IFRS 12, IAS 27, 2011, paragraph 16a. Investment entity consolidation exemption was introduced into IFRS 10 by, like I've read this line before. by investment entity issued on 31st October 2012 and effective for annual period beginning on or after 1st January 2014. When a parent other than a parent covered by the above circumstance or an investor with joint control of or significant influence over an investee prepares separate financial statement, the parent or investor shall identify the financial statement prepared in accordance with IFRS 10, IFRS 11, or IAS 28 as amended in 2011 to which they relate. The parent or investor shall also disclose in a separate financial statement, IAS 27, 2011, 17. The fact that the statement are separate financial statements and the reason why those statements are prepared if not required by law. A list of significant investments in subsidiary, joint control entities and associates, including the name, principal place of business, and country of incorporation, if different, proportion of ownership interest, and if different, proportion of voting rights, and a description of the method used to account for foregoing investment. Applicability and early adoption. IAS 27 as amended in 2011 is applicable to annual reporting period beginning on or after 1st January 2013. IAS 27.
Okay, thank you very much. Now let's now break it down to what aspect we are going to discuss. Okay, the aspect to which we have a discussion border on how do we identify the form of purchase consideration? What mode or means will the consideration come in? And also, how do we recognize this consideration at acquisition date fair value? And what kind of accounting entry we pass to such as an acquisition? And for those that may have subsequent effect or subsequent implication with respect to measurement, how do we carry them out subsequent to acquisition? All of these are what we want to discuss, and we'll be discussing them strictly within the parent separate financial statements. And okay, at this point, we'll go back to our notes to now identify that what are the forms of considerations that exist within a group. Purchase considerations. Forms of purchase consideration. Now, the first form is what we call the cash consideration. The second one, which is also notable, is what we call shares consideration. What is the difference? Cash consideration is where you offer money in exchange for acquiring shares in another. While share consideration is where you exchange your own shares to receive the acquired entity's shares. We call this shares consideration, or what some people will call shares exchange. Now, in addition to this, we could have asset consideration, which means assets is being transferred. What it means is this. The parent or the acquirer might have assets, tangible or intangible or both, where the value is commensurate and can be transferred out to the former shareholders of a company, and you take over the whole company by way of shares, which means you acquire their shares, and what you offer to them is a set of assets. For example, probably company A has assets in Banana Island, Roland, and the land worth 1 billion naira, and is acquiring a subsidiary for the same 1 billion naira. And based on the agreement, the owners of the subsidiary are willing to sell and in lieu collect assets. that banana island property because they know they can always sell it. And on the premise that it may even appreciate at the point of selling. And therefore they offer to collect it. And in that situation, asset was exchanged. But this is a rare occurrence, but it's something probable. Another one is debt consideration. Debt consideration is where you borrow to finance acquisition. And one of the ways of borrowing is that you can issue bonds to raise capital. Some you can borrow from banks, borrowing from banks, that's financial institutions. And third one is that the amount you're supposed to pay by way of cash, you can turn it to borrowing in the hands of the former owners. Borrowing, I can call it implied borrowing. Implied borrowing from the former shareholders of the acquired entity, which is the acquiree. Okay, now in addition to all of I've said, okay, before then, acquisition can be combination of those above, combination of aforementioned. What does that mean? What it means is that you might buy a company for $10 million and $4 million might be cash, and the remaining $6 million might be shares. Like that. Okay, lastly, in addition to what we have above, we will have these other ones in addition. They are always in addition, and I will explain. Deferred consideration, or what some people call deferred payments, and contingent consideration, which some people call contingent payments. These are in addition to the above. And I'll explain when we get there. Okay, these are the forms of consideration probable, and this can be a mixture as the case may be. Now let's look at our position here. I want somebody to read this. Janet, are you there? Madam Janet?
Yes, sir. Yes, sir.
Okay. Can you read this up for us?
Okay, sir. Accounting for investment in parent separate statement of financial position. IS 27, paragraph 18, separate financial statement requires an entity preparing separate financial statement to account for those investments at cost. Equity method as described in IS 28 or in accordance with IS 39, IFRS 9, financial instruments. IS 27, separate financial statement contains accounting and disclosure requirements for investment in subsidiaries, joint ventures, and associates when an entity prepares separate financial statements. Separate financial statements are those presented by a parent, that is an investor with control of a subsidiary, or an investor with joint control of or significant influence over an investee, in which the investment accounted for at cost, equity method as described in IAS 28, or at fair value in accordance with IAS 39 or IFRS 9 financial instruments. Technical note, financial statements in which the equity method is applied are not separate financial statement. Similarly, the financial statement of an entity that does not have a subsidiary, associate, or joint venturer's interest in a joint venture are not separate financial statements. Transactions and events accounted for as business combinations. A business combination results from the occurrence of a transaction or other events that result in an acquirer obtaining control of one or more businesses. This can occur in many different ways that include the following examples individually or in some cases in combination. 1, transfer of cash, cash equivalent or other assets, including the transfer of assets of another business of the acquirer. 2, incurring of liabilities. 3, issuance of equity instruments. 4, providing more than one type of consideration. Or 5, by contract, a loan without transfer of consideration, such as when A, an acquired business repurchases enough of its own ordinary shares to cause one of its existing investors, now the acquirer, to obtain control over it. B, there is a lapse of minority veto rights that had previously prevented the acquirer from controlling the acquiree in which it held majority voting interest. C, an acquirer and acquirer contractually agree. An acquirer and acquiree contractually agree to combine their businesses without a transfer of consideration between them.
Okay, thank you very much. Now that speaks to some of what I've discussed earlier. Now, let's go back to our note. IFRS 3 requires us to, IAS 27 requires us to carry out some relative accounting. Now, when we come back here, okay, there's an exception given by IAS 27. Now, IAS 27 requirements with respect to separate financial statements. Now, IAS 7 allows us to recognize a parent, like any other investor in associates, joint venture, can recognize its equity investments. I remember when we say equity investments, we are looking at it with respect to ordinary shares investment in a subsidiary or an investee, either at a cost or at fair value. And when we talk about fair value, we are talking about fair value with respect to the requirement of IFRS 9. Whereas cost is a sole requirement of IAS 27, which is an exception to the general rule. And what is the general rule? The general rule is that financial assets, especially when it comes to equity investment, are to be measured at fair value. But in this case, subsequent measurement can either be at cost or fair value. But at initial recognition, when acquisition takes place, there is a convergence in most cases where the fair value relates to the cost, which is the transaction price or purchase consideration, as the case may be. That's why you find out that in the balance sheet of a parent entity, which is a separate balance sheet, which is different from the group, usually you find out that the amount of investment continues to be carried at cost, which reflects what it is. Okay, but again, if they are to follow strict requirement of IFRS 9, if this exception has not been given, it will have been measured at fair value, which brings about changes on a yearly basis. Which means that in that situation, the fair value gain or loss attributable to such investment have to be reversed before consolidation can take place. That is if peradventure they've done it at fair value. But usually they do it at cost because of the provision of IAS 27. Okay, one of these days, probably we'll look at an example where what if it is measured at fair value? How do we go back and make relevant adjustments for the fair value changes that is incorporated in the separate financial statements before consolidation of the subsidiary can take place by the parent? Now, the question then is, in addition to this, we are now interested at the point of acquisition, how do we at the point of acquisition, how do the parents initially recognizes its equity investments in a subsidiary in its separate financial statements? Remember, there's a general principle that one, all financial assets, financial liability, and even most times all assets initially are recognized at fair value. All because the fair value is always an approximation. In most cases, except in very few situations, which we look at when we get financial instruments, are measured at the transfer price, which is the transaction price, sorry, which is the price offered in exchange to buy that asset or to incur that liability. It's usually the fair value, and which is also the cost when you are making reference to it in the future, or because cost means transfer price that has not changed since that transaction originated. But fair value changes along with time, market condition, and situation. Now, in this case, the general principle is fair value, which approximates the transaction price. Okay. Now, how do we recognize any of this with respect to the consideration that may have taken place, either as cash or as exchange of shares, or asset transfer or debt consideration, and in situation where there's combination, and in extreme situation where there's deferred and contingent consideration. Now, in that light, we will look at these illustrations, and I want somebody with a very more or less less noisy background to volunteer in this case. Okay. Let's look at the scenarios that we'll be considering. Who will volunteer? And the person must have a good network. Okay. Can you unmute?
There is noise in my background. I'm attending.
Okay. Okay.
Okay, scenario A, cash consideration. Given the statement of financial position of parent PLC, immediately prior to the company investing in the entire shares of subsidiary limited on 31st December 2015 at a cost of 50 million naira. And this investment is here to be accounted for in the financial statement of the investor as shown below. Can you hear me? Okay. Statement of financial position as at 31st December 2015. PPE 300 million. Current asset 120. Total of assets 420. Share capital and reserve. Equity share capital at 1 naira per share 250. Reserve retained earning 90. Current liabilities 80. Total of capital and liabilities stood at 420. Suppose the consideration of 60 million offered is a cash consideration to the equity holder of subsidiary limited, which is made upon acquisition. The investment should be recognized in the separate financial statement of the parent as at the day of acquisition based on the provision of IAS 39 IFRS 9. The fair value of the cash consideration of 50 million should be recognized as a financial asset in the separate financial statement of financial position of the parent based on the following entries. Debit investment in subsidiary and credit bank as component of current cash, current assets 50 million naira. The separate statement of financial position of parent after recognition of the investment in the financial assets of subsidiary will be depleted as follows. Parent PLC. Statement of financial position as at 31st December 2015. Property, plant and equipment 300 million. Investment subsidy 50. Current assets 120 minus 50 17. Total assets stood at 420. Share capital reserve. Equity share capital at 1 naira per shares. Share capital and reserve. Equity share capital at 1 naira per share. 19 naira reserves. That's 340. Total equity current liabilities stood at 340, and then current liabilities 80. Total equity and liability 420. That's all.
Thank you. Now, let's look at the situation. The investments, if you go back to the question, was made and the acquisition cost was 50 million. Now, but this was the balance sheet of the company, that is a parent, before the acquisition. And therefore, there was no acquisition reported here. Now, they've given us a description of how the acquisition came to be, that the acquisition was by way of cash consideration. I think we can see it here. Okay, and here they told us that suppose the consideration offered was cash, how are we going to treat that in the books of the period in line with IAS 27? Now, the fair value of the consideration is 50 million, as the case may be here, which is the transaction price. Now, how do we reflect it here? That 50 million has created what we call financial assets, which is in form of investment in a subsidiary. And we have parted away with cash, which is a component of current assets, which means as we introduce another class of assets, which is investment in subsidiary, we are going to recognize a depletion, or what I can call a reduction in our current assets. Remember, cash is a component of current assets. In this case, we have lumped all the current assets together, probably trade receivable, inventory, cash. And therefore, we need to reduce this because the cash has gone out and what is coming in is the investment. By this nature, we recognize an accounting entry to say that for this investment to be recognized as an asset, we need to create or identify the class of asset, which is investment in subsidiary, and debit it with 50 million. The corresponding effect is that our bank or cash position has reduced within our current asset by 50 million, and that's why we are crediting it. What will be the effect of what we've done here subsequent to the acquisition is that our property, plant, and equipment has no effect because it's not affected, but beneath it, we have recognized investment in the subsidiary, which is 50 million. Now, beneath that, we have current assets, which was originally 120 million, but because out of it, we have paid out 50 million with respect to this acquisition. Therefore, the 50 million has gone out, and what is left is 70 million. And by the time we construct this balance sheet, this is what the balance sheet of the parent company will look like immediately after acquisition, while all other aspects remain the same. And this is the reason why when you have balance sheet of the parent, you always have it included in it investment in subsidiary. And this was a process we'll have gotten through before presenting our balance sheet in the separate financial statement of the parent as does. Does that make sense to you? Okay, now let's look at a situation whereby we are looking at the same balance sheet and we are looking at the same costs of investment, 50 million. But what is different now is that rather than assume that it was cash consideration, now we are told that it is a share consideration, which means there were share exchanges, which means the parent is offering his own shares, issuing more of his shares in exchange for the shares acquired in the subsidiary. Now, with the same balance sheet and with the same amount, but what is different is cash consideration. What will be the effect? Can you read that for us? Scenario B, over to you.
Share consideration or share exchange. In some instances, consideration can be offered in the form of shares exchange or transfer between the shareholder of the parent acquirer and that of the subsidiary acquiree, as opposed to cash consideration, which was earlier considered in the illustration above. The recognition of cash consideration, the recognition of the shares consideration will be measured at fair value based on the proposition of IAS 39 IFRS 9. The fair value of the share consideration of 50 million, hypothetically being 40 million shares at the market price of 1 naira 25 kobo, should be recognized as a financial asset in the statement of financial position of the parent based on the following accounting entries.
Okay, thank you. Now, in this case, let's say we acquire 40 million shares in the subsidiary, and the market price of subsidiary shares at that point was 125 kobo. And that is what makes up the 50 million consideration. Now, since it's not cash, it is shares. How do you account for it? Remember, when you issue shares, you increase your equity. But equity has two components here with respect to capital. Now, one component is on share capital. The other component is on premium. Peradventure, your market price at the point of issue is higher than the nominal price. Now, given here that the nominal price is 1 naira, it then means that there's a premium of 25 kobo, and that is what brought about the split between share capital and premium of 1 naira and 25 kobo. Once you multiply them by 40 million shares, it gives you 40 and 10, which sum up to the 50 million consideration in exchange for the investment, which means the former owners of the subsidiary will surrender their shares worth 50 million for our own shares worth 50 million. And invariably, exchange has taken place, which means if you go back to this initial balance sheet, where nothing has taken place before, the new position of the balance sheet after the share exchange is that, yes, our investments will come up as 50 million. Now, if you check here, nothing affects the current asset because we are not paying with cash, which means we are still retaining what our current asset position is since nothing has impacted it. Now, but our share capital has increased because originally we had 250 and there was no premium. But now we have issued more shares to new set of people because of they've given up their own company to us. Therefore, my total share outstanding now is about 290 million naira. with a premium of 10 naira, if you remember from the accounting entry. And when you check, there was no 10 naira before, there was no share premium before, which means for the first time we are introducing share premium as a result of the business combination. And our reserve remain what it is. And this is the position post-acquisition in the separate financial statement of the parent, reflecting the acquisition, the cost of acquisition, and the impact by way of issuing shares. Now let's now look further at where, back to the same question, okay, where we now look at it that, okay, the 50 million, we paid partly cash and partly shares. And where we have that situation, how will we account for that? That will take us to scenario C. Over to you.
Scenario C, combination of cash and shares consideration. Furthermore, the combination of cash and share consideration can take a position in the acquisition in subsidiary. The combination will be treated in consonance with early treatment above, as it relates to cash consideration and share consideration. Assuming partly cash of 20 million naira was made, while the remaining as share equity consideration. The fair value of the cash consideration of 20 million and the share consideration of 30 million. Hypothetically, being 30 million share at the market price of 1 naira should be recognized as a financial instrument in the separate statement of financial position of parent based on the following accounting entries. Debit investments is.
Now let's look at it now. In this case, the 50 million comprises of cash and shares. And now in the shares, it was 30 million shares we are issuing at market price of 1 naira, which probably coincided with our nominal price of 1 naira. Therefore, and this might be common, probably because the parent itself is a private company, which has no shares traded in the market. If that is the case, that means that our investment has been recognized as 50 million. But the impact of recognizing the investment is that we created additional shares, which we issue, which is worth 30 million. It means our equity share capital will increase by 30 million. But our current assets will reduce by 20 because we paid cash of 20 million out to make up for the difference. Invariably, what happens? Before now, our balance sheet look at those. Therefore, there was no investment and our share capital is like this and our current asset is 120. But what is it now? Subsequent to that effect is that our investment surface, but in this case, as opposed to other situations where current asset depleted by 50, it only reduced by 20 because it's only 20 we paid out. Now, the other 30 is accounted for by we issuing additional shares of 30 to make up 280. And this represents our balance sheet, given that the exchange or the consideration comprises of cash of 20 million and shares of 30 million. Now let's look at a situation where we borrow to acquire a subsidiary. What will be the effect on our accounting or on the balance sheet of the parent subsequent to that acquisition? Over to you. Can you continue?
Scenario D, debt consideration. The investor acquirer can also explore the opportunity of issuing debt instruments towards raising cash for the acquisition or investment in investing company. The debit can either be issued outrightly to the interested public investor or issued in exchange for shares in the investing company, but the latter is rarely common. The debit will be recognized as a financial liability in line with the requirement of IAS 39 IFRS 9 and simultaneously recognize the investment made with a cash proceed from the insurance of debt security in the subsidiary in separate financial statement as a financial asset. Given that a 10% convertible debt was issued to finance the cash consideration to the equity holder of the acquired company, the fair value of the financial liability debt security issue and financial asset cash consideration of 50 million will be recognized in accordance with the provision of IAS 39 IFRS in the separate statement of financial position of the parent based on the following accounting entries: financial liability, issuance of 10% convertible stock, convertible security, debit bank. Should I go ahead? Credit 10% convertible debt, 50 million naira. Then financial instruments, cash consideration for shares acquired in subsidiary, debit investment in subsidiary, and then credit bank, 50 million naira. The effect of above entries based on the assumption that 50 million naira was raised through debt security and that same amount of 50 million used in acquisition, and that there exists zero new consequence of the company cash and bank position, assuming no transaction and issue of floating costs, the separate financial statement of parent after recognition of a financial liability through debt instruments and investment in financial assets through cash consideration in the subsidiary will be depleted as follows. Parent PLC statement of financial position as at December 31st, 2015.
Thank you. Now, if you look at this question, now we assume that there is no transaction cost or anything. We went to the bank to borrow 50 million. And in doing that means that the money in our bank account will increase by 50 million, but our liability will also increase by 50 million. And that is what this first entry did, to recognize our liability. But also, the money we brought in, we immediately use it to acquire a subsidiary by way of cash consideration. We paid all of the 50 million out to acquire the subsidiary, and our bank balance will reduce. Now, all things being equal, one, that there's no transaction cost or any other related cost for borrowing and investing. Two, that the exact amount we borrow is the exact amount we invest. You find out that the balance in the bank account will nil off, which means what it means is that you borrow 50 and you spend that 50, which means the effect on the bank is zero. What is now left is that your investment can be seen standing in the subsidiary, and it is only standing because you have an obligation on a convertible debt, which you have used as a mode of financing that acquisition. And that's why when you come to the balance sheet, what you find out is that what? My investment surfaces as 50. My current asset has a zero effect. Why? Because it's in and out based on those assumptions I've made, which remain as 120, the initial cash you borrow and the cash you expended for the acquisition. Now the equity share capital remains the same, but what is now coming here and surfacing for the first time is a component of the non-current liabilities, which is a convertible debt of the 50 million that finances this acquisition. And this is how you could see the balance sheet of a parent company immediately after acquiring a subsidiary with a form of debt financing or borrowings. Okay, now let's now look at what I said earlier. Okay, earlier I told you that I can have all of this and the combination of them. But we now have deferred consideration and contingent consideration as what? These are considered to be what? Addition to the above. Okay, and what does that speak to? I'll give you a small explanation. Imagine you want to buy a subsidiary and the seller says the subsidiary, they are selling it for 50 million. But you only have 40 million naira cash. And you have more or less agreed to buy it at 50 million, but you have 40 million naira cash. And you offered, and you don't want to issue your shares. And you now agree with them to say, okay, I'll pay you 10 million naira in the next 1 year. And they agree. Or you say in the next 2 years, and they agree. That 10 million naira is simply what we call a deferred consideration, which means the total consideration in its face value is 40 million cash consideration and 10 million deferred cash consideration, which means is a cash consideration you pay in the next 1 year or 2. Okay, now how does that differ from contingent consideration? It differs in this manner. Imagine the seller wants to sell the company for $52 million. I said, no, I can only pay $50 million. After a long puzzle, you came to an agreement. It's okay. Why do you even want me to pay 52? And the owner of the acquired entity tried to convince you to say that the reason why it is 52 is that we know that their potential values are associated with this acquisition based on the value we have inherent in this business. And you are not convinced enough. But you now have a conviction to say, okay, if I'll pay 52, let me pay the 2 million in the next 1 year or 2 million in the next 2 years. And this 2 million, which I'll pay in the next 2 years, is conditioned upon the attainment of those metrics, those performance targets that you have sugar-coated that are embedded in this company. And if they agree, that means that there's condition to it. The 2 million will not necessarily be paid if those conditions are not met, or will partly be paid if part of those conditions are met, or will fully be paid if all of the conditions are met. In that situation, you have created a contingency, which is a probable obligation on the possibility that future events that seems uncertain may occur or may not occur. And those are the thin line between contingent consideration and deferred. Now, I'll allow you to read this up, and thereafter, I'll come towards accounting implication and the slight difference between accounting implications and treatments of contingent consideration and deferred consideration within the group accounts. Okay, over to you.
Still on the note.
Yeah, over to you now.
The effect of the above entry is based on the assumption that 50 million was raised through debt security.
You've done that. We've done that. Scenario E.
Deferred or contingent consideration. The concept of contingent consideration and deferred consideration can also be evaluated as a condition, as a consideration offered by the investor to the investee, which requires further consideration being made at a future date. Deferred consideration involves an agreement made that requires part of the consideration for the business combination be paid in the future without any condition being attached. That is, it is a consideration that will be made in the future with certainty. While contingent consideration is the future consideration, which is based on the occurrence or non-occurrence of future uncertain events that possibly exist based on attainment of some level of performance or target by the acquired company, sometimes into the future. A special case may involve contingent consideration that require payment after the payment of the sum of 10 million naira cash to acquire the shares of the subsidiary. But the contract may be subject to a clause relating to contingent consideration which stipulates that if certain criteria are met in the second year of ownership, relating perhaps to performance in terms of profitability, a further 2 million naira would be payable to the former shareholder of the subsidiary. IFRS 3 revised required where an element of consideration is contingent of future events. The element should be included in the overall cost of acquisition without considering further whether it is probable. Unlike in the previous IFRS 3 that requires the adjustment or inclusion of contingent consideration only if the condition is probable, that is, chance of more than 50% of its occurrence, but must be able to measure reliable based on the fair value. The fair value of contingent consideration should be measured based on the present value of future consideration payable, which is determined based on the investor's hurdle rate at its cost of capital or acquisition date fair value of the equity instrument transferable. Some changes in the fair value of contingent consideration deferred consideration that the acquirer recognizes after the acquisition may be the result of additional information that the acquirer obtained after the date about the facts and circumstances that existed at the acquisition date. Such changes are considered measurement period adjustments in ascertaining the real amount of goodwill. However, changes resulting from event after acquisition day, such as meeting an earning target, reaching a specific share price, or reaching milestone on a research and development project, are not measurement period adjustments. The acquirer shall account for changes in fair value of contingent consideration, deferred consideration, that is not measurement period adjustment, as follows. Contingent consideration or deferred consideration classified as equity shall not be remeasured, and in subsequent settlement shall be accounted for within equity. Contingent consideration, deferred consideration classified as an asset of liability that, if is a financial instrument and is within the scope of IFRS 9 or IAS 39, shall be measured at fair value with any result gain or loss to recognize with either in profit or loss in other comprehensive income in accordance with IFRS 9. It is not within the scope of IFRS 9. IAS 39 shall be accounted for in accordance with IAS 37 and the IFRS and other IFRS as appropriate. Technical notes. The accounting treatment of deferred consideration and contingent consideration is the same based on the revised IFRS 3, which no longer require the payment of contingent consideration to be payable before it can be recognized as part of the fair value of the consideration upon acquisition. The technical difference in treatment of deferred consideration and contingent consideration is not at the point of initial or subsequent recognition, but at due date of payment, which requires the recognition of the liabilities for contingent consideration if the condition of payment no longer exists at the date of payment. Where contingent consideration involves the issuance of ordinary share, there is no liability, obligation, or transfer economic benefit. Recognize this as part of the equity under a separate caption representing shares to be issued. That's all. Thank you.
Thank you very much. Now, when we talk about this, both contingent and deferred consideration to be measured at the acquisition date present value. That's number one thing you need to note. Okay. And two, unlike before now, contingent consideration should only be recognized at initial recognition when it is probable. But today, the position of the standard is that it should be recognized whether probable or not at the point of acquisition, once there's a reliable basis to measure it at acquisition date fair value. Which then means that contingent or deferred consideration are to be recognized at the acquisition date fair value. Now, this consideration can either be, can further be broken down into contingent or deferred cash consideration, contingent or deferred asset consideration, and contingent or deferred shares consideration. But of the three, the one that is more common is of cash consideration. Now, if it's cash consideration, what happens is that subsequently you remeasure it at the fair value. And the fair value there will be approximated as the present value of the cash flow, okay, which will be called the fulfillment value. And we're going to look at it later. Okay, which means we will now apply the requirements of relevant standard to doing that. Now, secondly, what if the deferred or contingent consideration is share-based, which means it's a share consideration? Okay, you measure it at fair value of those share instruments at the point of acquisition. But one thing that is unique about shares, which we are going to learn, we have deferred many things on into IAS 32 under financial instrument, is that equity is only measured once in its lifetime, which is at the initial recognition, which means equity are not remeasured subsequently. Why? Because equity represents the residual stake, and that's why they are not remeasured. In that case, it means there will be subsequent changes in the equity portion of the deferred or contingent consideration, probably until the end of the period in which delivery of those equity have to take place. Okay. Likewise, if it's assets, okay, you measure the assets at the fair value at the initial recognition, and subsequently, depending on the nature of the asset, you apply the relevant standard to those assets in their capacity, whether they can be measured as the case may be, which means if it's a landed property, it then means that such can be measured over time. And that is the position we're trying to look at, which then means that let us restrict ourselves now to cash consideration that is subject to changes. Okay, for deferred consideration, the whole process is just unwinding of discounts, or because it's just by way of passage of time. But for contingent consideration, it's a mix of both unwinding of discounts where applicable, plus probability of likely meeting those conditions, which can either more or less reduce, unchange, or increase the possibility of those obligations where applicable. And on that premise, how do we do all of this process, and what subsequent effect does it create in the process of preparing the consolidated financial statements of the group? And that's what we're going to look at with this illustration. Okay, we have this illustration also speaking to where we started from. This is where we started from, where you are aware that in the balance sheet, investment has not been recognized. But now we have acquired by way of cash consideration, but we also agreed to pay a further cash of 10 million upon attainment of certain conditions in the next 2 years. Therefore, how do we incorporate this first at the point of acquisition to produce a new balance sheet at acquisition? And second, subsequent to acquisition, what are the effects of this? Okay, over to you, this illustration. Okay, can you read the illustration?
Sorry, my internet went off. Where, please? Cash consideration of 50 million naira was offered the shareholder of acquired company, and also agrees to pay for that 10 million 30th July 2016 upon attainment of certain performance in the next 2 years, as shown below. And given information that the investment in financial assets is yet to be accounted for in the separate financial statement for investor. Assume the parent order rate at cost capital is 12%. Parent PLC. Statement of financial position as at 30th June 2014. Property PPE 300 million. Current assets 120 million. Total assets 420 million. Share capital and reserve. Equity share capital 1 naira per share. Reserved, retained any 90. Current liabilities 80. All total of capital, reserves, and liabilities 420. The fair of the entire consideration upon acquisition we have to be recognized in the separate financial statement of the investor parent, which include the fair value of cash consideration of 50 million naira offered paid, and the fair value of the contingent consideration of 10 million payable in 2 years' time. The fair value of the entire consideration transferable upon acquisition in the sum of 57.97 million naira, as shown below. Cash 50, and then contingent consideration 10 raised to 1.12 raised to power negative to the annuity. Okay, that's 7.97, which is that means the 10 billion naira 7.97. The fair value of the cash consideration of 50 million naira and the present value of the fair value of the contingent consideration of 10 million naira, which is 7.97 based on discount rate of 12%, should be recognized as a financial asset in separate financial financial position of the parent based on the following accounting entry. Debit, investments in subsidiary 57.97. Credit bank current asset 50 million. Credit contingent consideration 57 million. 7,9.97 million. 7.97 million. Yeah.
Thank you. Now, let me now try to delineate it with this illustration. Okay. Now, we wanted to determine our purchase consideration. parents. And to do this, all figures in millions. We need two things: cash consideration and here we have contingent because there's condition attached to it, consideration. First, cash is known as 50, but contingent consideration is not known. Someone will say, how come? How come? Because it is only the face value or the future value of the contingent consideration that is known, not the fair value. And here the fair value approximates the present value, which means what we require, what is required is the fair value, which is equivalent of the present value because cash is involved. Therefore, what it then means is that given that this is the timeline, this is date of acquisition today. This is 2 years' time when settlement of that deferred consideration, contingent consideration is required, and which means in future contingent consideration payment dates. Now, the question is, what is X? Given that 10 million is payable in 2 years' time, we need to rely on the principle of time value of what? Money. Rely on the principle of what? Time value of what? Of money. Therefore, in this case, what do? We need to find a way of discounting this 10 back to today, which is over 2 years. When we break it down, we have year 1, which is this period. And we have year 2, which is this period. Remember, it's 2 years from the information provided. Therefore, to discount back, remember, the present value is the future value. The present value is the future value discounted by 1 plus R raised to power n, or simply put, the future value multiplied by 1 plus R raised to power minus n. Now, where our R is the cost of capital, or what some people would call the ordinary rate or rate of return on the business or equity. Now, in this case, the present value today, which is period 0, and this is period 2, and this is period 1, is simply the future value in period 2 discounted by 1 plus R period 2, which is simply as the future value in period 2 times the discounting factor, which is raised to power minus 2. Now, what is the future value? It's 10 million multiplied by 1 plus, we are given the ordinary rate to be 12%. This 5 minus 2. Now 12% is 0.12 plus 1 will give us 1.12 raised to power minus 2. When you press your calculator and get this raised to power this and multiply by this, what you get is 7.97, which shows that our x is 7.97, which means the present value is what matters, because you can't be recognizing 10 million today when it's the same 10 million you get to know, which means what we have is 50 and 7.97 to make up 57.97, which was the accounting entry that was shown earlier. Now, let me show you again the accounting entry. And therefore, we'll look at how does the balance sheet looks immediately after. You can see what the balance sheet looks like after the acquisition. Now, see the entry, investment is not 50, neither is it 60, but it is 57.97. And the mode of investment is that you pay cash of 50, which depletes your bank balance within your current assets and increases your liability by way of contingent liability, contingent consideration as a liability of 7.97. Now, when you compare these two balance sheets, let me try and reduce it. You can see how they look like. Now, between these two, we now have investment is subsidiary at 7.97 and current assets reduced by 50 million because of these payments, and a liability surfaces, not current liability. It is not current because as at acquisition, we have 2 years to go. Okay, but if it's 1 year to go, we'll group it under current liability. And that's how we have the 7.97. At the end of the day, this is a new balance sheet being produced immediately after acquisition. Any question on that before I move further? Any question? Yeah.
I have a question. My question is, since the future value is going to be 50, and that's what we recognize in our financial statement.
Future value is not 50.
Okay, sorry. Future value, present value is 57.97. But we know that in future.
No, not present value, not present value. Present value is not 57. Let us pick it one by one. Cash has no problem. What we are doing present value is contingent consideration that we are more or less measuring at present value, because 10 million I will give you in 2 years' time is not 10 million today. It's equivalent of 7.97, given that the cost of fund is 12% per annum.
Okay. Understood.
Yeah.
So what I'm saying now is that in 2 years' time, we're giving 10, but we are recognizing today 7 million and approximately 8 million. How do we augment for the remaining 2 million difference when that's future?
Yes, that is what we are to do now. Remember in my explanation before now, I said, what will be the effect at acquisition? And for those ones that might have subsequent effects post-acquisition. And that's a good question. Now I'm back here, which means we need to first of all ask ourselves a simple question. What is the difference between this 10 million in future? What's the difference between this 10 million in future and this X, which now we have agreed is 7.97, which means we come here and say, the difference the face value of the contingent consideration is 10 million. While the present value of the same is 7.97. First, what is the difference? This is 2.03. The question then is, what is it? What is the difference? Or what constitutes the difference? The difference is what we know as a finance cost, otherwise known as cost incidental to borrowing. Because we are borrowed, that's what it means. Because what we are supposed to pay, we are paying it later, and we are paying it at a cost of 2.03, which means if I'm to pay today and I've dropped this amount, I won't have this exposure in future. And for me to borrow 7.97, I repay 10, it means the cost of borrowing is 2.03. Do you agree?
Yes.
If you are supposed to pay somebody 8 naira today, but the person say, okay, if you can't pay me 8 naira today, you pay me 10 naira tomorrow. The question is that it costs you 2 naira for you to defer your payment into future, and that is finance cost. Does that make sense? Now,
yes.
The second order there is this finance cost is for 2 years. This is for what? 2 years. Then, if it's for 2 years, then how do we, since I'm not the only one, do we recognize it over the 2-year period? How do we recognize this over the 2-year period? For simplicity, somebody will wake up and say, I just divided by 2. I recognize each year 1.015. But that has no basis in accounting. When you get financial statement, you understand why. That means that no, we must find a scientific way of amortizing this finance cost over 2 years. And we are going to use the basic principle of amortized cost, or the same basic principle of unwinding the discount. Because this 10 million, the discounted value is 7.97. Therefore, as time now goes on, when this is 7.97, when we go 1 year in time, it will be 7.97 plus. And when it comes from this plus to this, it must be able to give us that 10. So that the difference between 7.97 and 7.97 plus will give us year 1 finance cost amortized. And the difference between 7.97 plus and 10 will give us year 2 financing cost for year 2 as amortized. And when we add these two together, it will give us back our 203. The question then is, how do we do that? We do that through the process of unwinding of discounts. I'll come here, unwinding of what? Discounts. And that will give me my finance what? Cost. How do you unwind discounts? Is to look at it again. This is date of acquisition, period 0. This is year 1, end of year 1, and this is end of year 2 where settlement is due. It means 1, 2. And remember, this is 7.97 now, which means if you compound this and come here, what will it give me? It will give me A, which is unknown. And when I compound A to this, it should give me what? B. Therefore, and in this case, the finance cost here will be equal to A minus 7.97. And the finance cost, which is year 1, and finance cost for year 2 will give me B minus A. The question then is, what is A and what is what? B. And we're going to use the basic principle of compounding, because when you are moving forward, it's the principle of compounding. But when you are moving backwards, like in this case, when you are moving backward, is the principle of discounting. Okay. Now, let's switch back to the material, and I'll come back to use illustration again to depict our understanding. Okay, can you read technical note here? I'll move on. I'm waiting.
The background is noisy.
Okay, can Janet do that?
Okay, sir. Technical note. The contingent consideration is treated in accordance with the provision of IFRS 3, which requires the present value of the consideration to be considered as part of the cost of investment, and equally the corresponding credit liability is treated in line with the position of IAS 37, which is regarded as a provision for non-current liability, as the consideration is payable in cash in 2 years' time, but would have been recognized as current liability if the consideration is payable within 1 year. Kindly note that if the contingent consideration is payable in equity shares, IAS 39 IFRS 9 will be applied, and such equity value is not to be remeasured. Let me continue, sir.
Yes, please.
Assuming 1 year after the acquisition of the subsidiary, the further implication of the acquisition date recognition principle will be the unwinding of the discount inherent in the contingent to profit or loss, that is income statement of the group, and simultaneously recognized as an increase in the liability for contingent consideration as shown below. The unwinding of discount on contingent consideration. Debit consolidated income statement, credit liability contingent consideration, 0.96 million naira. The discount unwound is determined based on the increase to the present value of the contingent consideration, measured 1 year after the acquisition, as calculated below. Unwinding of discount, 12% of times 7.97 million naira is equals to 0.96 million naira. Or alternatively, contingent consideration in bracket measured a year after, 10 in bracket 1.12 raised power minus 1, 8.93 million naira. Contingent consideration as measured at acquisition date, in bracket 7.97 million naira. Discount unwound, 0.96 million naira. The implication of the unwinding of discount of the approximate sum of 96 million naira is that group profit is charged with a finance cost, being the discount unwound, and the group liability towards contingent consideration increases to 8.96 million naira. That is 7.97 million naira plus 0.96 million. Furthermore, at the end of the second year, there are two possible outcomes, which include: one, the condition attached to the contingent consideration is being attained. Two, the condition attached to the contingent consideration is not being attained. If the performance, which is the condition attached to the contingent consideration, is met, this discount unwound in the sum of 1.07 million naira as determined below will be availed the same treatment as earlier displayed and as shown below. The unwinding of discount on contingent consideration: debit consolidated income statement, credit liability contingent consideration with 1.07 million naira. The discount unwound is determined based on the increase in the present value of the contingent consideration measured 2 years after the acquisition as calculated below. So I can't see below, sir. As calculated below, unwinding of discount, 12% times 8.93 million naira is equals to 1.07 million naira. Or alternatively, contingent consideration measured 2 years after, 10 into bracket 1.12 raised to power 0, that's 10 million naira. Contingent consideration measured a year after, in bracket 8.93 million naira, then the discount unwound 1.07 million naira.
Yeah, thank you very much. Now, what have they done? Okay, let's go back to our notes. What they've done is this. For me to find A, remember this A now. Okay, A is the same thing as a future value in year one, if you are looking at it from today, and today is period 0. Or A is simply as present value in year 1, also from today. Okay, which means there's always a convergence where future value in year 1 and present value in year 1 will converge once they are of the same period. Now that means that my present value in period 1 is simply for me to compound my present value in period 0. And compounding is plus r raised to power 1, and I'm compounding just from this period to this period, which is just one distance. And what is present value in period 0? Is 7.97, which is this. 1.1 to remember my discount factor or my discount rate, and I'm discounting for 1 year. Once I do this, what we get is 8.93 in millions, which means A is now 8.93. And if it's 8.93, I can now say that, or alternatively also, I can say PV. Remember, this is also future value in year 1. I can say PV in year 1 is you discount the future value in year 2 by the cost of capital 1 period, which means whatever that is here, I can discount it here just once. And what was here? our future, which is in period 2, we said is going to be 10. I want to discount it back here. Now, to do that, it's equivalent to, I remember this is same thing as future value in 2 and this, which means I'll come here and say 10 million times 1.1 to raise to power minus 1. When I find this as a factor and I multiply by 10, what I get also is 8.93. You can check with your calculator. Which means regardless of the position I take, I'll get the same answer. Hence, my finance costs, which is same thing as the unwound discount, if you go back, I said is the difference between A and 7.97, which means my finance cost is now this A minus 7.97. And what is A now? 8.93 and 7.97. And that gives me 0.96 in million of naira. Alternatively, you can also get it by saying the cost of capital, as mentioned in percentage, multiplied by your present value in year 0. What does that mean? Imagine I borrow 7.97 today, and I pay interest at 12%. What will be the interest I'll pay for 1 year within this period? And that's what it means. Which means, in that case, it will be 12% times 7.97, and which is going to give me 0.96 million. Hence, I can come here and say this amount is 8.93 minus 7.97 would give me what? 0.96. And that is the finance cost for year 1. And what will be my accounting entry? I'll debit the parent's profit or loss as a result of finance costs, and I'll credit the contingent consideration. And what happens to that? It increases the contingent consideration by 0.96 million. And that is why 7.97 has now come to 8.93. That is year 1. The same process will be replicated for year 2. Okay, in year 2, my finance costs in year 2 is as follows. Let me first of all find the present value in year 2. Remember, the present value in year 2 is similarly to future value year 2, discounted by this. But again, because year 2 is the final year, 2 in 2 will give you 0, because year 2 is the final year. There's no other future because settlement is to take place here. Therefore, in that manner, what will happen in this case is that anything raised to power 0 is 1. And that is why you can also see here that there's always convergence, as I've said earlier, that the future value of the same period will always equal the present value. And this is a point of intersection. And that's the only point of intersection. Therefore, which means this is 10 million already. But to prove it, let me prove it. Present value in period 2 can be gotten from present value in period 1, discounted for one, compounded for one period, which means what I mean here is this. You borrow 8.93 in year 1, and if you attract 12% interest, what will be your interest in that year 1 up to year 2 is simply for that one period, which is 8.93 multiplied by 1.12 raised power 1, which will give you 10 million. If you are not convinced enough, I can still tell you that the PV in year 2 is same thing as PV in year 0, but compounded for 2 periods. Now, what are the 2 periods? This is period 0, which means if I want to get B from period 0, I have to move how many steps? 1 step forward, and the second step forward. 1 plus 1 will give you 2 at a go. Therefore, in that situation, what happens? That's what created these 2 steps. And therefore, it means 7.97 times 1.12 raised to power 2 will give me 10. All of this is just to satisfy righteousness. Therefore, the finance cost or the unwound discount for year 2 will be the future value in year 2, which is 10, less the present value in year 1, which is 8.93, and that gives 1.07, which is same thing as what we have here as A minus B, sorry, B minus A, which is same thing as B minus what? A. And what is B? 10. What is A? 8.93. And that is that. Similar vein, the accounting entry will be a charge to the parent's profits because of the finance costs, and a credit to the contingent consideration. And therefore, what we have? 1.07 in millions. Okay, and that's what we've done in that respect. Okay, let's go back to our solution. And look at it from that perspective. Okay, can you read further, Madam Janet?
The implication of the unwinding of discount of the appropriate sum of the approximate sum of 1.07 million naira is that group profit is charged with a finance cost, being the discount unwound and the group liability towards contingent consideration increased to 10 million naira. That is 8.93 million naira plus 1.07 million naira. The balance of 10 million naira outstanding as at end of year 2, 30 June 2016, will be payable in cash for such liability to be extinguished, and accounting entry will be debit liability, contingent consideration, credit cash and bank, cash and cash equivalents, which gives which is 0.96 million naira.
No, let's take note. It's not 0.9, it's with the 10 million.
Yeah.
Now, that is what you use to extinguish. Take note. It is not 0.96 million, but
10 million.
10 million naira, being the face value of the contingent consideration. You get what I'm saying now?
Yes, sir.
Okay. That is that. Now, continue from there. What if the performance was not met at all? How do you treat that 10 million naira that you have already accrued for?
Okay. Where the performance is not achieved has been set upon acquisition of the subsidiary. The amount of the contingent consideration may be reversed in total or partly based on the proportion of the condition met and as may be agreed in the contract, and will be treated as a change in accounting estimate based on IAS 8 accounting policies, changes in accounting estimate and errors, which requires a reversal to the income statement of the group at the date the contingent consideration becomes no longer payable in full or in part, which implies relevant portion being recognized as the liability of the group as at 30 June 2016. In this case, and where the full amount is derecognized, the following accounting entry is required: debit liability contingent consideration, credit group profits with 10 million naira. Technical note: the fair value of the contingent consideration at acquisition could be different to the consideration transferred, and any differences are normally treated as a change in accounting estimates and adjusted prospectively and not retrospective in accordance with IAS 8.
Now, when we get to IAS 8, I'm going to share a video of which will be on-demand learning for you during the week, where you listen to my deliveries with respect to requirement of IAS 8. And therefore, you'll be able to understand what constitutes an accounting policy and how does that differ from an accounting estimate. And how can we take that out of the scope of accounting errors? And where there are changes in accounting policy, how do we account for them retrospectively? And how do we account for changes in accounting estimates prospectively? And how do we restate the account when there's a change in, where there's a correction of an error? But now, in this case, we are saying that we are making a gain, which is other gain, by the fact that the liability is no longer payable. Because if it's paid, we will have depleted our cash. But when it's no longer payable, it's going to more or less serve as an income. And if you remember from the conceptual framework, whenever anything will impact your equity positively, and it arose from the fact that there is a reduction in your liability that does not require settlement, in that case, we'll consider that as simply put as an income. And that is what has happened in this case. Okay, in that light, let us summarize all what we've done so far on this tabular form. Who will volunteer to summarize all what we've done by this tabulation?
Tabular appraisal of investment accounting in separate financial statements. Mode of consideration, fair value measurement, accounting entries in separate financial statements of the investor. Cash consideration, amount of cash. Debit investments in subsidiary, credit cash and cash equivalent. 2, shares exchange transfers, current market value or its equivalent measurement of fair value for unquoted equity. Debit investments in subsidiary, credit ordinary share capital, credit share premium. 3, deferred cash consideration, present value of the amount of the cash based on time value of money, TVM, debit investment in subsidiary, credit liability. Secondly, okay. Therefore, deferred shares transfer, current market value or its equivalent measurement of fair value for unquoted equity, debit investment in subsidiary, credit other components of equity, deferred shares reserve. Contingent deferred cash consideration, the contingent deferred shares transfer. Nevertheless, on how or probably the occurrence of the uncertain event, the considerations are required to be measured at its fair value at acquisition date. Debit investment in subsidiary, credit liability, that's for contingent deferred cash consideration, and debit investment in subsidiary, credit other components of equity, deferred shares reserve, that's for contingent deferred shares transfer. So I'm done with that, sir. Okay. Tangible asset transfer, fair value of the asset transferred, such as raw land or properties. Debit investment in subsidiary, credit disposal of assets with the fair value of the asset transferred. Debit disposal of assets, credit assets, e.g. properties, with the carrying value of the asset transferred. Debt consideration, proceed on issue of debt if issued to third parties or agreed exchange value of issuing debt to existing shareholders of the investee or subsidiary. Debit investment in subsidiary, credit financial liabilities, debt obligation.
Okay, thank you. Can you wrap it up with the summary of chapter 3? And we'll call it a day. Thank you.
Okay, sir. Summary of chapter 3. 1, a parent company that prepares group accounts may have separate financial statements. 2, CAMA requires a company that prepares group accounts to also prepare and present separate financial statements. 3, separate financial statements are those presented by a parent that is an investor with control of a subsidiary or an investor with joint control of or significant influence over an investee, in which the investments are accounted for at cost, equity method as described in IAS 28, or at fair value in accordance with IAS 39 or IFRS 9 financial instruments. 4, there are different forms of the consideration that could be exchanged in a business combination, which may include cash, shares, asset transfer, debt instruments, deferred and contingent considerations. 5, all considerations arising from business combination should be measured and recognized at acquisition date fair value. 6, deferred and contingent consideration, other than those attributable to the subsequent issue of shares, should be measured at present value. 7, deferred and contingent considerations regarding the subsequent issue of shares should be measured at acquisition date fair value, which is synonymous to the fair market price. 8, contingent consideration should be recognized at the acquisition date, whether or not it is probable to be settled in the future or delivery of shares will be made upon occurrence or non-occurrence of future uncertain events. 9, movement or changes in the fair value of present value of the deferred and contingent consideration should be recognized in profit or loss of the parent. 10, where upon settlement or at due date, the contingent consideration is no longer required as the condition or conditions precedent to its settlement is not met, the amount so accrued or provided for until they should be recognized as a liability and reported as an income in the books of the parents.
Thank you very much.
Yes, sir.
Thank you very much. And
Thank you, sir.
Yeah, thank you very much. On this premise, we'll be having further discussion in the next section, where probably we'll be talking on chapter, okay, I think chapter 9. In chapter 9, we'll be looking at adjustment in group accounts. But before then, I'm going to share some resources with you. And on this premise, we'll call it a day. Thank you very much.
Excuse me, sir. Sorry. Excuse me, sir.
Yeah, I can hear you.
Yes. I actually want to ask, are we still going to consider a question on probably share exchange, debts, and the other considerations aside the one we just contingent consideration?
We've done that. We've looked at how to recognize each one of them.
Okay. I was just making reference to a practical, like a question.
No, we are coming to that. First, remember, our approach is not just solving questions. Our approach is to discuss principle first. And here we've discussed principle of recognizing them, as the case may be. And this is a principle that will guide you in case you find yourself in a situation where it was not recognized. What then do you do? If you don't have this understanding at the background, anything they are doing, you will not know what is the basis of it. You only come or just say, they do it. But why do they do it? And how do they do it? Do you understand? And that is what we've discussed today. When we now get to practical concentration, for example, let me take you to this. Under chapter 14, you see, okay, chapter 15, you see some critical questions like this. For example, you see a question where they said, on 1st of October 2012, application acquired 75% knowledge shares by means of share exchange of 2 shares in application for every 5 shares. This is one. How do we apply all of this if we've not done the underlying principle? 2 years, they said application issues shareholders of knowledge 100 Naira 10% loan note for every 1,000 shares he acquired. The knowledge you have garnered all through that is what will bring us to this level. Do you get what I'm saying now? Let me also look at another question here,
yes,
which also depicts similar situation. Now you can see a similar question here, talking about, okay, look at it here. There's an exchange of 10 million shares with a cash payment of 80 kobo, which means there's a deferred payment here. Deferred until, that is it. We must have underlying principle that we understand, which we more or less harness in solving.
It's all right, sir. I just wanted to.
Okay, no problem.
It's all right, sir.
Okay. Thank you, and God bless you all. We'll see next week. Thank you very much, and bye.
Thank you, sir.
Yeah, thank you, guys.
Thank you, sir. Have a wonderful week ahead.
And you too, guys. Bye.